Is the world stock market a bubble waiting to crash because of AI? In just the last quarter, Nvidia reported $26.4 billion in profit. At the exact same time, Michael Burry, the guy who predicted the 2008 stock market crash, just placed over $1 million bet that Nvidia and Palantir are about to crash. He's shorting 1 million Nvidia shares and 5 million Palantir shares. Palantir CEO, on the other hand, Alex Karp, called this batshit crazy on live television.
The idea that chips and ontology is what you want to short is batshit crazy.
Meanwhile, the Bank of England and the IMF are quietly using the word bubble in their official reports for the very first time since the dot-com crash. So here's what we need to figure out. Is AI the biggest wealth creation wave of our lifetime? Or are we watching trillions of dollars and rupees that are about to get vanished when this bubble pops? Because one side is about to be spectacularly wrong. And if you're investing money right now, you need to know which side that is. Hello everyone, I am Uday Nadde and I've been licensed in Indian financial services since 2015. And so far, I've helped over 2,000 families make better financial decisions. And here on my YouTube channel, I talk about all things money and personal development. Today I'm breaking down both sides of this AI war with actual numbers and how it affects the stock market and even your Indian investments. I'm sharing 5 points on why it could be a bubble and 5 possible counterpoints. Finally, I'll share a strategy of how to play this right now. So let's get into it. We'll start with why smart people think we are inflating a massive AI bubble right now. Here's red flag number 1. Valuations are beyond stretched. The IMF's latest financial stability report says equity valuations are fairly stretched. And here's the scary part. A tiny group of AI megacap stocks now drives almost all index returns in the United States. This concentration is higher than it was at the peak of the dot-com bubble in 2000. The Bank of England went further. Their governor explicitly compared today's AI valuations to 1999 and warned an AI-related asset price bubble if expected returns do not materialize. Now add to all of this, US employers have announced over 150,000, that's over 1.5 lakh job cuts in October 2025. That is up 175% year on year, and it's been the worst October since 2003. And companies are openly saying that AI and automation are behind these cuts. So we have sky-high valuations concentrated in a handful of stocks on one side, plus rising economic stress. And that's not a great combination. Red flag number 2. Some profits are actually accounting magic. Now, Michael Burry is claiming that big tech companies are juicing up and increasing their profits with accounting tricks. And he's not wrong. Alphabet, Microsoft, Meta and Oracle all recently extended the useful life of their servers from about 3 to 4 years to 5 to 6 years on paper. Now, when you stretch depreciation schedules like this, your reported expenses drop. So your profits go up without you selling a single product. Google's change alone added roughly 32,500 crores to its operating profit. Microsoft added about 31,500 crores. Meta is expected to add 24,000 crores in 2025. That's almost $3 billion US dollars. Now, is this illegal? Absolutely not. Is it aggressive? Absolutely yes. But it does justify some skepticism, right, about these record profits that are reported in headlines. Red flag number 3 is the power problem that nobody is talking about. The International Energy Agency estimates that global data centers' electricity use will more than double by 2030, reaching levels similar to Japan's entire electricity consumption today. And AI is the main driver behind this increased consumption. Morgan Stanley projects the US could face a 45 gigawatt power shortfall by 2028 just from AI data centers. They are absolute energy guzzlers, as you can imagine. That's enough to power over 30 million homes. That's over 3 crore homes. In Santa Clara, Nvidia's backyard, new data centers worth almost 100 megawatts are built but sitting completely idle because the grid can't supply enough electricity to them. And here's the kicker. Hitachi Energy CEO says AI data centers can spike power demand tenfold within seconds, and that can threaten grid stability across entire regions. So even if the demand for AI is real, the infrastructure built out might hit hard physical limits that slow everything down. Red flag number 4. Most companies aren't making money from AI yet. The Bank of England cites MIT research showing that about 95% of enterprise AI projects are not yet delivering a clear financial return. So boards are spending like AI is the next internet. But inside the CFO's spreadsheet, most projects still sit in the PowerPoint promise stage, not the actual profit stage. If too many CEOs wake up in, let's say, a year and a half and say we have spent billions of dollars and our margins haven't improved, think about it. AI infrastructure orders can dry up very quickly or slow down. Red flag number 5, China's cheap innovation wave. 2 years ago, everyone said the US is miles ahead of China in AI and China will take forever to catch up. That story is long dead. Now there's an entire wave of Chinese AI models that are beating the best models from Silicon Valley. The loudest example from just the last week is Moonshot's Kimi K2 thinking. It's a fully open source AI model, and on humanity's last exam, it's a benchmark test, it actually beat the likes of ChatGPT 5 and Claude Sonnet 4.5. And estimates suggest that Kimi K2's training cost was around $5 to $6 million, which is debatable, while OpenAI's ChatGPT training cost is estimated to be over $1 billion US. So if you can build frontier AI models for that low cost, then the entire narrative that only the $1 trillion big tech can afford to play this game, that completely falls apart. And remember, Kimi is not the only model. China has got a lot of powerful AI models that are competing with the best in the world. Now add what Jensen Huang, Nvidia's own CEO, warned that China could win the AI race because of two simple advantages: cheaper energy and fewer rules. And you can see this in numbers. Chinese provinces like Gansu and Inner Mongolia are offering roughly 50% electricity discounts to AI data centers that use China-made chips. That brings the effective power cost to just a few cents, 5 to 6 cents per kilowatt hour, plus direct cash incentives that reportedly cover a data center's power bill for an entire year. At the same time, Beijing has mandated that new state-funded data centers must rip out foreign AI chips and switch entirely to domestic accelerators from Huawei and Cambricon. That starves Nvidia, AMD and Intel of future China revenue while forging scale onto local chip makers. Now let's be fair, right? I've listed 5 red flags, but you can't just yell a bubble and come across as genius. The bulls, the people betting big money on AI actually turning out to be a big investment, have serious ammunition. So here's counterpoint number 1. The money is absolutely real this time. Unlike the dot-com era, these companies have massive real earnings. Nvidia's latest quarter reported 3.9 lakh crore in revenue, 2.2 lakh crore in net income. Palantir's revenue grew 63% year on year with hundreds of millions of dollars in net income and contracts with governments and major enterprises. This is not a pets.com story, right? These are actual companies making real money. AI infrastructure and AI operating systems are where actual dollars are landing right now. If you want to apply what I share here on YouTube to your own life and investing, check out my program, The Complete Guide to Mutual Fund Investing. It has all my years of experience of being licensed in Indian financial services since 2015. In it, I've covered topics like how you can select mutual funds to invest in, how to build your mutual fund portfolio, a much deeper dive than this particular video, what is an SWP and how to plan for your various goals, among other topics as well. The guide also has Excel tools like this one, where you just enter the goal that you have, the money that you require for it, and it automatically tells you, factoring in inflation, how much you need to invest per month from now onwards and which mutual funds to go for to save for that goal. Once you sign up for the guide, you'll also be part of our monthly live Q&A sessions where I answer all your doubts. To check out the program, go to the first link in the description and the pinned comment. Then comes counterpoint number 2. This is a genuine platform shift. Every major tech boom that created real wealth had a platform behind it. Think of the PC, the internet, or even the smartphone. AI looks like the next one. Jensen Huang talks about global AI infrastructure requiring trillions of dollars in investment this particular decade, replacing roughly 83 lakh crore of old data center equipment and perhaps building about 166 to 250 lakh crores of new AI factories. And this is not just one wave, it has 3. Firstly is the training wave, building giant models where we are now. The second is the inference wave, running these models billions of times every single day. And the third is the edge wave, moving AI into phones, cars, and factories. So a stock may look insanely expensive on this year's earnings, But if AI structurally increases IT spending as a share of GDP, current multiples might look reasonable in hindsight. Counterpoint number 3. Efficiency can expand the market, not kill it. Chinese AI models showed that you can do more with less, but here's the twist. When efficiency improves, total consumption also increases. If AI costs per query drop by 80%, more companies can afford to run heavier models. New use cases become viable. Overall compute demand can actually explode. Foxconn expects AI server shipments to double next year. So yes, efficiency compresses unit pricing, but if volume growth outpaces these price cuts, the total revenue and total profits can still soar. Counterpoint number 4. Geopolitics actually creates more demand, not less. Export controls, sanctions, nationalist AI stacks, it all sounds scary. But from a pure demand perspective, a two-pole AI world probably creates more total spending. Both the US and China need chips, data centers, power and software. Many countries will hedge by using both ecosystems. And because China still depends heavily on Nvidia hardware and TSMC manufacturing, a lot of that spending still flows through the same global supply chains. DeepSeek's delay due to chip shortages actually proves that point. And counterpoint number 5, AI is literally holding up global growth. Here's the irony. The IMF warns about an AI bubble while simultaneously saying that AI-driven investment is one of the main reasons global growth has not collapsed yet. Without AI spending, global GDP and stock markets would have potentially looked a lot worse. So policymakers are nervous about a bubble, yes, but also kind of need it to keep things going. And that's why timing this as a short is dangerous for retail investors like you and me. Being right too early in markets feels like being absolutely wrong. Now, what does this mean for you as an Indian investor? Now, here's the fascinating part. India can be the biggest beneficiary if AI trade actually cools down. Right now, foreign investors have roughly pulled about 1.5 crores out of Indian equities in 2025. Kotak Institutional Equities says India has a negligible presence in the global AI value chain, warning we could become a funding market, meaning foreign investors could sell India to fund AI trades elsewhere, which is what has potentially been happening, right, in the past 1 year. But here's the flip side. If the global AI bubble kind of deflates, capital may rotate back into India as an anti-AI safety trade. HSBC just called Indian equities a hedge against the global AI rally, projecting significant upside in 2026. Now remember, any of these projections, no matter who makes it, you have to take it with a grain of salt because at the end of the day, it's just a prediction that is made by them. So right now we are being punished because India is not in the AI frenzy. But that lack of AI exposure could become an asset when investors decide they are overexposed to tech. If the AI bubble bursts violently, everyone suffers, yes, including India. But if it starts cooling down kind of gradually, India could be where stable money rotates into. Now enough of theory. What does this mean for your portfolio? First up, don't try to be a Michael Burry. Shorting Nvidia because it's gone up a lot, its valuation is very high, isn't a strategy for regular investors like you and me. We just don't have enough unlimited margins or the risk appetite for it. Secondly, think of the barbell. On one side, you have exposure to some quality AI infrastructure through diversified funds and ETFs, and on the other side, you hold boring stuff that doesn't live or die on the AI sentiment. So broad equity, debt, even some gold. Third, focus on picks and shovels, not on shiny apps. The application layer is risky. Dozens of AI startups are surviving with very thin moats. The resilient part is power infrastructure, network equipment, and semiconductor tools. You don't need to chase the flashiest AI stock to benefit from the spending cycle that is currently happening. Fourth, separate your content FOMO from your portfolio reality. You'll see endless content on Nvidia, for example. But the bulk of your long-term wealth, ask anyone who's made long-term wealth, right, will still come from being disciplined, going through downturns, not pulling out money, investing as much as you can, right, increasing your investment capacity, sticking to the very seemingly boring asset allocation based rules. Now, India is under-owned because of AI FOMO elsewhere. That's not necessarily a bug. It might be the feature giving you better entry points. So yes, own the AI investments, but don't forget about everything else as well. Finally, accept you won't time this perfectly. No one ever has. Can we be in a bubble? Yes. Can this bubble double or triple before it pops? Also yes. Remember, Amazon dropped over 90% after the dot-com crash, then went up hundreds of times from that point on. Your goal isn't to tell your friend and brag that I told you so. Your goal is to own enough of the future to build wealth without blowing up if and when the narrative shifts. Here's the bottom line. Michael Burry is not crazy. The Bank of England and the IMF, they aren't hallucinating risks. Yes, AI valuations are stretched, and they are stretched because they promise for a significantly better future with higher growth, higher revenue, and a lot of corporate spending at the same time has not proven itself yet. But writing off the entire AI boom is probably just as wrong. The earnings are real, the infrastructure built out is real, the platform shift that we see happening around us is real. So instead of picking team boom or team bubble, play it like a grown-up. Stay exposed to AI without being addicted to it. Size your positions so you can survive a 50% drawdown in your AI stocks or investments without panicking. So keep building your boring diversified core portfolio while the world fights on whether this is a bubble or the next boom. And finally, I genuinely believe this. The best way to play this AI wave is to learn about AI and apply it to your work and business. Because that's the best way to make most money from it, because that gives you a lot of money to start investing in all these places. If you enjoyed watching this one, then check this one out as to how you can build your core boring portfolio if you had 10 lakh rupees today.